All right, let's talk about one of the most popular and, honestly, one of the most misused tools in all of trading, the RSI. You see it on practically every chart out there. But the big question is, are you actually using it the right way?
Because that's really what it comes down to, isn't it? The RSI gets pitched as this super simple, buy here, sell there kind of tool. But you know what? Following that common advice is a huge, and I mean expensive trap for beginners. So today, we're going to show you why it fails, and then we're going to show you a much smarter way to use it.
Okay, first things first, let's do a quick rundown of what the RSI is and what most people think it's supposed to do, just to make sure we're all on the same page. So RSI stands for Relative Strength Index. At its heart, it's all about momentum. The best way to think about it is like a speedometer for the market. It's not telling you the price, it's telling you the speed and the strength of the recent price changes. And it does that on a simple scale from 0 to 100, basically trying to tell you when something is getting relatively cheap or expensive. And this is how almost everyone learns to read it. You have two main levels to watch, 70 and 30. The story goes, when the RSI line climbs above 70, that's overbought territory. It's getting pricey. And when it drops below 30, it's oversold. It's getting cheap. Sounds simple, right? Well, this is exactly where the problems start.
All right, let's get into it. Let's talk about that big, costly beginner's mistake and why just trusting these overbought and oversold zones can get you into a world of hurt.
I bet you've heard this a million times online. The RSI dips below 30, it's oversold, it's on sale, it has to go back up, so you should buy. It seems so logical, so easy, and that's why this strategy gets passed around everywhere.
But here is the brutal, honest truth. When a stock is in a really strong downtrend, it can hit that oversold area and just live there. It can stay oversold for days, weeks, even longer, while the price just keeps on falling. So if you buy just because RSI hit 30, you're not getting a bargain. You're trying to catch a falling knife. And that's how you rack up loss after loss. The indicator isn't broken, the strategy is.
So that brings us to the most important question, right? If just buying oversold and selling overbought is a total disaster, then how in the world do the pros use this thing? What are they seeing that everyone else is missing?
Well, the answer is a single concept that changes everything. And that word is divergence. This is the secret sauce. This is what separates the novices from the pros. It's about finding a disagreement, a conflict between what the price is doing and what the RSI is doing.
So, what is divergence? Put simply, it's when your price chart is telling one story and your RSI is telling a completely different one. You know, maybe the price is grinding down to a new low, but the RSI is like, nope, not me. That disagreement is a huge clue that the current trend might be running out of gas. Now, divergence comes in two main flavors. First up, you've got bullish divergence. This is your potential buy signal. This happens when the price on your chart makes a lower low, but at the same time, the RSI makes a higher low. It's a sign that the selling pressure is secretly getting weaker. And then the opposite is bearish divergence, your potential sell signal. This is when the price pushes up to a higher high, but the RSI makes a lower high. It's a little warning that all that buying momentum might be fading away.
Okay, spotting divergence is a massive upgrade. But, and this is important, it's not a crystal ball. If you just trade on divergence alone, you're still taking a big risk because you're fighting the trend. That's why you need a safety check. You need confirmation.
Think about it like this. A divergence is just a whisper. It's the market hinting that, hey, something might be about to change. But acting on a whisper is basically just guessing, right? You need to wait for the price itself, the actual price action on the chart, to shout at you and prove that the reversal is actually happening.
So here's your simple three-step game plan for that. Step 1, you spot the divergence. That's your clue. Step 2, draw a very simple trend line connecting the most recent highs or lows of the price swing. And step 3, this is the most important part, you wait. You do nothing until the price actually breaks through that trend line. That break, that is your confirmation.
So, let's put it all together into a clean, simple, and much smarter RSI strategy.
Here it is, your new RSI checklist. It's just two parts. Part 1, identify the divergence. You're hunting for that conflict where the price and the indicator are moving in opposite directions. And part 2, you wait for confirmation. No jump in the gun. You patiently wait for the price to actually break its immediate trend line. It's only when you have both of these things, the signal and the confirmation, that you have a high-quality setup worth looking at. And really, this quote just says it all. This is the professional mindset. Indicators like the RSI, they're not magic wands. They don't predict the future. They are support tools. Their only job is to add a little bit of extra evidence to what you're already seeing on the most important part of your screen, the price chart itself. Always remember, price is king.
So we'll leave you with this question to think about. This whole idea of separating a signal from its confirmation. It's so much bigger than just the RSI. It's a fundamental principle of smart trading. So take a look at your own charts. Which other indicators are you using that are just giving you whispers? And where are you waiting for that loud, clear proof?